we're hearing we've got 10, 12, 15% unemployment, but the stock market's at all new highs. We have stimulus that seems to be benefiting the wealthier folks and those who own assets like real estate, whereas the lower income folks don't seem to be getting as much of that and are kind of struggling. And it's difficult to predict, how is that going to settle out?
It's my pleasure to welcome Andrew Cushman to the show. He is a real estate investor, apartment syndicator, and has some interesting thoughts on demographics that we want to look into. As I said 10 years ago, and I recently renewed my 10-year forecast for another 10 years. I said that the demographics coming at the rental housing market for the next 10 years, I said this 10 years ago, are nothing short of phenomenal. And I'm renewing that prediction because the next 10 years look incredible as well. So Andrew, welcome. How are you?
I'm good. Thanks for having me on, Jason. It's good to talk with you. And I would agree with your assessment 100%.
Yeah. You've got about 1,800 apartment units that you've syndicated. You've done a lot of home flipping and investing. We met through a mastermind group that we're involved in. I had the pleasure of speaking at that group in January. You've really done some good stuff. So where are you located, by the way? You're in Orange County, where I used to live, right?
Yeah, I live down in Southern California, not far from, your old home of Newport Beach. And then we primarily invest in Georgia and Florida. And then we also like the Carolinas and Tennessee. And we used to be in Texas. So.
Mm-hmm. Good stuff. Well, talk to us just in general about, your macro view of the market in terms of real estate, the economy in general, and then let's get into these rental demographics. And by the way, folks, if you're watching on video, we have some good visual aids. Feel free to make comments down below if you're watching on video, and then if you're only listening to the audio, we'll try and translate the visuals into a way that you can understand them as well. Okay. But what's your macro view?
So, the economy in general, I'm telling you, that's a tricky one right now, right? We've got, we're hearing we've got 10, 12, 15% unemployment, but the stock market's at all new highs. We have stimulus that seems to be benefiting the wealthier folks and those who own assets like real estate, whereas the lower income folks don't seem to be getting as much of that and, are kind of struggling. And it's difficult to predict, how is that going to settle out, right? What is real unemployment? What's people's real incomes? What's real occupancy going to be? We call the appearance of the coronavirus, a black swan event. I don't know what the opposite of that is. Maybe white penguin or who knows. But it would take just about a miracle to just make this all just go away, right? There's going to be some repercussions, and when I study it and then when I talk to people far smarter than me, I get completely opposite conclusions, right? One person can have a great argument for why everything's going to be fine in 6 months. And then I listen to somebody else who has a great argument for why this is going to be the next Great Depression. So I think the reality is probably going to be somewhere in the middle. And what the question I like to ask is, as far as investing goes, what can I do to put a tailwind at my back or, wind in my sails so that almost no matter what the outcome, I should be in a good position. And that's when that's where I look at, okay, what asset class or what investment class has those tailwinds? And to me, rental real estate is probably the best positioned to benefit from not only the long-term trends that you alluded to, Jason, before this started, but what's going to be accelerated by the current crisis, right? So, for example, we've already talked about, there's been much talk about the baby boomers starting to downsize and move into rentals. And, already there was a trend for them to want to age in place, not move to the retirement center, but to stay in a house or an apartment or something like that. They're the second largest generation. There's 70 million of them, and they are in the process of downsizing and renting, so they have the flexibility, the lower payments, they don't have to worry about maintenance, all of that, right? So we've had that trend going on. Behind them is Gen X, which is a smaller generation, right? That's you and I, and we're starting to get to the point where lifetime warranty doesn't sound like quite as great deal anymore. But we're kind of in the middle, and then after that, we actually have the biggest generation, and that's the millennials, and they're from 1981 to 96, depending on who you're talking to. It gets defined a little bit differently, but that generation is 72 million. They're even bigger than the baby.
It's interesting because as you quote these numbers, the demographers disagree on how many millions, because, I've always gone with the number that the baby boomers are 76 million, the millennials are 80 million, slightly bigger, Gen X, my generation, only 46 million. So folks, just understand the demographers vary depending on the cutoff year. They do fudge a little bit on it. It's not a big deal. The concept is the same, but go ahead.
Yeah, you're exactly right. If you compare, Freddie Mac versus, Pew, or they'll have different numbers, but the
Pew
overall,
Research Center.
the overall trend is about the same. And so the millennials are getting to the point now where they're forming households, but they're very unlikely to buy because, number one, a lot of them tend to value flexibility and amenities, and they don't want to take care of a house. But even a bigger factor is the multi-trillion-dollar student debt bubble, right? Though that is preventing many of the millennials from being able to buy houses. So they are becoming renters. And not only are they becoming renters, they're staying renters much longer than previous generations, right? So we have two huge waves of demand crashing at the rental market. And this applies equally to single family and multifamily, right? There's different preferences and, you can parse out, but the demand is there regardless. In fact, even right now, single family demand seems to be even slightly higher than multifamily. Mm-hmm. As people seek space and move out of cities and things like that.
But again, the multifamily has to be defined in terms of, what type of multifamily is it? Is it high rise, mid rise, low rise, garden style? It's just so much different. And this is why, folks, you can't listen to the national news media and their soundbite analysis. It just isn't good enough. Go ahead.
Yeah. There's a lady on CNN who's been predicting the demise of the housing market for the last 10 years, right?
Oh, and Peter Schiff has been predicting the end of the world for 20 years, and Zero Hedge has been predicting it forever, and it's just it's really annoying, frankly.
Yeah, well, and we have a mutual friend, David Osborne. What he says is, don't wait to buy real estate and wait.
Yeah, right? that's the saying I operate by too. Yeah,
you got to ignore the noise and buy something that makes sense today, and then hold on to it. So that's the demand side. On the supply side, and this data is coming from Freddie Mac, so this is kind of the same thing, where depending on your source, the numbers might add up a little bit differently. But they estimate that demand is 1.62 million household units per year, right? So that that's the demand for housing every year, and we haven't supplied that level of homes or apartments since 2007. So what that means is every year since 2007, we've been running a deficit and increasing the severity of the housing shortage. And now that's varied, right? In 2009 and 13.
Yeah. A note on that, by the way. And in 2011, that was a short, brief anomaly, okay, because of the over construction that occurred, because the lending was so ridiculously liberal. There really was a housing shortage way before that also. Mm-hmm. There was this brief spot, like a snapshot in time of maybe a couple of years that there was actually an adequate supply of housing. But still, there was a very significant homelessness problem even then, or maybe especially then because it was recessionary time. And of course, that also is a stat you would have to parse up a zillion different ways in terms of location, product type, price range, et cetera, et cetera, et cetera. But go ahead. Yeah.
Yeah, you're absolutely right. There's some markets where there's 30% vacancy in rural, maybe declining towns, and then
and there's Detroit. Detroit's the poster child for disaster, right? And in Detroit, obviously, we saw them bulldozing homes for a while.
Yep. We're giving away for free, or all that kind of stuff. So we're consistently running a housing shortage. I think in 2017, even as things were strong and recovering, we were still short 370,000 units of housing. This has been going on for a decade. The current projection I've heard for 2020 is that we're up to, again, this varies depending on who you get the data from, but we're up to like 1.49, right? So getting there, but still short. And Freddie Mac has a projection, they have their high, their median, and their low. And they're predicting anywhere from a shortage of between now and 2030 of 900,000 to 4 million housing unit shortage, right? So when you have two large waves of demand crashing into the rental market, you have anywhere from 1 to 4 million unit shortage. That really leads to one thing, and that is increasing occupancy, increasing rent levels, and therefore increasing value on that rental property. And so when we look at just the macro picture within the United States, those demographic trends, which are set to play out for at least the next 10 years, especially as that millennial generation is just now starting to move into the rental market. That wave is about a 10-year long wave. That's going to push rental rates, push occupancy, and again, it's a huge tailwind. Now, that's the really high level picture, which even becomes really important as a real estate investor. And Jason, I'm going to share my screen here.
Okay. Right, now what we're showing here is data from Harvard University. Okay. And this is the Joint Center for Housing Studies. We're looking at a map of the U.S. And the great thing about this map that Andrew is sharing is that you can highlight an area like, say, for example, Memphis, one of the markets we've been recommending for many years, along with many others. Memphis is certainly not the only one. And you can look at the flow of the population, and it's pretty encouraging for investors for sure. Go ahead, Andrew. Do you want to highlight that one?
Yeah, so there's two maps here that I want to highlight. One is just total population change, and effectively, if you're a rental and if you're an investor in rental property, you want to position yourselves in the counties, and this is done by county, that are kind of this dark green or greenish blue color, right? That's where population growth is the strongest or the highest. And then the red colored counties are ones that are losing population, and then the white is where it's basically flat. So you look at your areas, of course, you've got tech, you've got San Antonio, I won't hover over it, blocks it, but you've got San Antonio, Austin, Texas, Dallas, Fort Worth, Houston. Most of Florida is high growth. Most of Tennessee, and then like Jason, you mentioned you're in Memphis. That's dark green. That's looking really good. Carolinas, Arizona, Utah, Idaho. There's markets all over the country where you have good growth, and even in some regions or states that are somewhat maligned for losing people, you can almost always find at least a county or a submarket that is growing for whatever reasons, right? Because you have different levels of domestic migration.
That's why all real estate is local. But the thing I do have to say as a caveat there is you have to look at the type of migration it is. Is that your target renter, for example? Mm-hmm. And you also have to consider, can you buy a property there that makes sense? Can you get a good rent to value ratio, et cetera? So, and the great example is California, my old home and your current home. And I almost hate to keep mentioning California, but it's the biggest state in the country. And if it were its own country, it'd be like the sixth largest economy. So it's a pretty significant thing. And it does show an example, a bad one, largely. Sadly, it's just so mismanaged, and it's really tragic. But California, is finally having some net loss of population, right? But over the years, it's had actually net gains. But the question is, who is the gain coming from? Is it coming from illegal immigrants, or as Hillary Clinton used to call them, workers without papers? I mean, you can't make up this politically correct, these are such lies. It's unbelievable. If they're all workers without papers, they don't have the income level that is going to make a good renter, right? To rent your typical house. So, you've got to really parse this stuff up. It's much more complicated than it might look on the surface, right?
And Jason, you couldn't have teed this up better. Let me show you, highlight exactly what you just said. So if you look at this map where I have up right now for total population change, California looks great, right? Lots of dark green color where they're, the highest rate of population growth. But if I go down to the legend at the bottom and I toggle it from total population change to domestic migration.
Meaning people moving from within the country.
Right.
California's terrible. The whole thing changes. Wow.
California turns red. So what does that tell you? Wait a second. The first map said California's growing like crazy, but the second one says it's losing people. Okay, well, who is it losing? Right. It's losing the people who have the good incomes that can afford to flee the state.
Yeah, right. Yeah.
And that's key right there, right? So you've got to look at both of these maps. It perfectly highlights what you were just explaining to everyone.
And one thing we should tell people about this, look, at the reason this is so important is because the people leaving are the tax base.
Yes.
They're the taxpayers, okay? And yes, there are some ultra wealthy people in California, sure. And then there's a lot of poor people. So it's a banana republic. And I don't mean the store. Look up the definition of banana republic. It's a country where you've got this ultra rich class and this ultra poor class and very little in the middle. What you want for a stable society is a large middle class, right? That's the important demographic, in my opinion. I love the middle class and love them or hate them, but so does Donald Trump. And so, this is the thing. The ultra rich people, they don't really pay much in tax a lot of times because they have so many sophisticated entities. They do offshore tax planning. They have all kinds of loopholes they take advantage of. And, these big companies in Silicon Valley and so forth, like Apple, shame on them, and all the rest, who are, they set up these companies in Ireland and, the Netherlands, and then they got another company, and they do this whole game to avoid paying taxes where they're really located. It's a complete scam. They just circumvent the law. And so when you lose the tax base and you lose those property tax revenue, then things start going downhill really quickly. And as we can see, California is desperate, and it's not the only place. There are many other places, New York certainly too. And they're really just attacking the population that's left there, becoming very predatory on them to collect revenue. I mean, New York it's just a huge problem. So when you see that happen, that is a hugely significant trend. This is really, really important. Just click on international migration for a moment, because that's kind of mixed. So let's just look at that one. What is that one telling us? That's pretty good in some of the areas, right?
Well, yeah, but and what it doesn't say is what kind of, it's not defining international. So if you look at it, Southern California's got a ton of international migration, right? So is that people just coming over the border and staying there?
Or is it rich people from China fleeing Chinese, oppression and moving their money to California, which it has been a lot of.
Right.
And California benefited from that. So
yeah, and just near where I live, literally about 2 miles down the road, there was an area that was largely Hispanic 15 years ago, and now it is completely Asian. All the signs, nothing's even in English anymore. It's all high-end Asian stuff, right?
Well, that's really a form of gentrification, if you will. So
yeah, so you're absolutely right. It makes a big difference. If you own rental property, that's a really important factor, right? And then if you look at Florida, you've got a ton of international migration as well. My guess is that might be the mid to higher income people, but I don't know.
Yeah. Well, in South Florida, I mean, that's pretty expensive, and that's a lot of Latin American, it's a lot of Brazilians, certainly a lot of Europeans, a lot of British people, hang out in Florida, and you've got the Canadian snowbirds. And so like anything, this is so mixed. And at the end of the day, you can parse and do statistics all you want, but I think for the pros, and this is why the pros are valuable, the people that are really just engaged in this stuff all the time, hopefully you think that's like the two of us, right? You just sort of get a feel for it. And
Hmm.
some of that is definitely anecdotal. It's not all empirical stuff. You just have a sense of it, really. Sorry, I can't give you more specifics than that. But yeah. Anyway, tell us more of the insights you learned from this map, and click on the total population change again. And let's look at, some of these markets: Indianapolis, Memphis, Atlanta, some of the Florida markets we really like, whether they be Jacksonville, Ocala, Southwest Florida. That's a bunch of different cities and areas.
Yeah, I mean, if you were to pick two states where it's almost hard to go wrong, it's Florida and Arizona. I mean,
Yeah.
whether you're looking at total population change or domestic, those two states are winning. And
Right.
what I mentioned earlier about as a rental investor, investing in an area where the wind is at your back. That's why these two markets are some of the most popular ones. Same thing with Memphis, right? It has both total population change and domestic at high positive levels. Same thing with Atlanta,
So,
Dallas.
yeah. So comment on Arizona, and you didn't mention a city there. You just said the state. First of all, again, you still have a lot of illegal migration
Mhm.
into Arizona, of course, but I lived there for 6 years. That was one of my favorite places to live. I really like Phoenix, Scottsdale, especially, great town. And we've recommended Arizona over the years several times. We've moved in and out of that market in terms of our recommendation, but it's just too expensive now.
Is it? Okay.
Yeah, it's not California, but it's still too expensive to really get the good rent to value ratios. And I got to ask you too, you can do it in Florida. You can have stuff that makes sense in Florida, many places in Florida, by the way. Certainly Memphis. You can't do it in Nashville. Nashville's too expensive. Indianapolis is great. Atlanta, you can still do it a little bit in Atlanta, and Little Rock, and many of the Texas cities have become too expensive too. We've
Yeah.
over the years had tons of clients buy in Dallas, Austin, San Antonio, and a lot of them are just too expensive now. But I got to ask you this: do you do any business in opportunity zones?
We don't. The reason being, we generally buy existing assets and renovate them and improve them. And to get the opportunity zone benefits to work out, it's more skewed towards developers, because you have to spend at least as much building or renovating as you paid to purchase the property. And that's really difficult to do with just renovating a 1980 construction apartment complex or something like that.
So I never got into the opportunity zone thing. I always thought it was highly overrated.
Hmm.
And I think my decision's pretty good. And here's why. Number one, COVID. A lot of those opportunity zones areas are the high density areas that people are leaving. And number two, civil unrest. And a lot of those are certainly opportunity zone areas.
Yeah.
And people are fleeing them now. Some of those areas just will not come back, maybe for, I don't know how long, maybe a generation, because no business in their right mind is going to open in those areas and,
No.
be vandalized and, not be able to operate because they have riots and these idiotic, disgusting leftist mayors will not enforce the law. They ought to be, frankly, indicted, these mayors, because they have an obligation to protect their citizens, and they're not protecting them because they're just selfishly wanting people to vote for them, and all their voters are rioting in the streets. So it's like a campaign rally.
Yeah.
You like that?
Yeah, that's okay. I may borrow that from you. Well, and you're absolutely right. And we mentioned this earlier, but the best way to guarantee success, especially rental real estate, is buy something that makes sense today. And what I see with a lot of those opportunity zone projects is they don't make sense today. Mm-hmm. They only make sense if everything comes together perfectly down the road and you get the tax benefit, right? So a lot of those opportunity zone deals are just bad deals, and a tax benefit doesn't necessarily change that.
Yeah, I always say, don't let the tail wag the dog. A tax benefit is great, but it should not drive your decision. The decision has to make economic sense. And one of my 10 commandments of successful investing is you keep repeating it for me, and I don't even know if you know what it is, but commandment number 5 is thou shalt not gamble. And the subtext to that is the property must make sense the day you buy it or you don't buy it, period. It's really quite simple. Thou shalt not gamble. So nothing extraordinary should have to happen for you to make a good return on investment. No extraordinary appreciation, nothing. just it should make sense from day one. Now, if some great things happen, like a bunch of appreciation, great, but don't count on it.
Yep, absolutely.
Okay, go ahead with what you're saying. And by the way, Gen Z, now the oldest Gen Zer, is 23 years old. And that's the biggest of all, 82 million people.
Yep, and they're about to get out and start renting. So yeah, so when we change it over to domestic migration, again, Florida looks really good. Lots of markets in Texas, Tennessee, Carolinas. Arizona still has that migration. Like as you said, it might be tougher to get the numbers to work. I don't invest in Arizona just because I don't want to be too spread out, so I don't have as much in-depth knowledge there. Utah, you can almost see where Highway 15 runs up through the center of the state. There's all kinds of growth there.
We love Utah, but again, too expensive. Many years ago we were recommending properties, and a lot of our clients purchased in Salt Lake City and around Salt Lake City. It's awesome, but again, that's a hybrid market. It's just too expensive. Many years ago we did a lot of business in Denver. Great market, but again, now people are priced out. So a lot of our clients made a lot of money in those markets, though.
So let me ask you, you seem to be doing a really good job of getting ahead of these markets. What you're doing is you're identifying emerging markets. We're looking at this data now, and everybody knows, oh, wow, Denver's been hot, Nashville's been hot, Memphis is great. Yeah. You've been there for a long time.
Well, we never got into Nashville. We just could never make Nashville work. And I love Nashville. It's a great town. That one never worked for us, but we did do Denver, Salt Lake City, Austin, if you can believe it. You can't even touch Austin now for the prices you need to as an investor. And even Dallas has gotten too expensive, even most of Atlanta. We do have Atlanta properties today. If you go to jasonhartman.com, one of our investment counselors, they can get you properties in Atlanta amazingly, but it's really hard to make Atlanta work.
Yeah. A lot, especially a lot of the secondary have gotten much more expensive and difficult to get them to pencil out.
Yeah. Tell us more.
Yeah. Well, I was going to say, so how did, maybe just for the listeners, you've done a really good job of getting ahead of the curve, right? One of the biggest ways to make money in real estate is to find an emerging market where population growth is about to happen, or income growth is about to happen, jobs are about to move in. And I know what we do, but what did you use to identify these markets early so that your investors benefited so much? Whereas it might be tough to get in now, but if they were investing with you 5 years ago, they already have a portfolio.
Yeah, or 10 or 15 years ago. I can't say there's any one thing. There's just a whole bunch of things. We interview people on the podcast all the time, just constant reading and research, and it's a bunch of fragmented stuff. It's not like I can give anybody one great website to go to.
Yeah.
And all the answers are there. I wish. It's just not that simple, but over time you notice trends and chatter. And
another thing I would say is if you're out looking at, okay, do I buy a single family house in this market or a small apartment, or do I do a syndication here or whatever? The same principles apply whether you're looking at the whole country or a state or a city or a region. So like, for example, take Atlanta. If you look at these charts that we've been sharing, most of Atlanta is dark green, right? Population growth, incomes have been going up there as well. But there are submarkets in Atlanta that I wouldn't touch with a 50-foot pole. Right? They're declining, very low income, very high crime, right? And so these same principles of positioning yourself where the right demographics are coming in, incomes are rising, you ideally have a business and landlord-friendly environment, right? You want to position yourself in those markets. So you start big picture, like, okay, Florida, Texas, Georgia. All right, well, what markets do I want? Okay, maybe Atlanta, maybe Tampa. All right, with the inside of Atlanta, am I going to invest in East Point or am I going to go out to Duluth, right? And those, very, very different markets. And so you want to apply those principles to every property you're looking at to help guarantee success, right? So if you're going to buy a single family house in Duluth versus East Point, you want to look at the income trends. You want to look at the population growth trends, and if you can get the data on that level, who's moving there, right? And it might take some digging, but you can find that out. And, I can tell you between those two, if I had a choice between East Point and Duluth, I'd be in Duluth hands down. So the same principles apply. That's a question I get a lot. Andrew, how do I just decide what market to invest in. I live in San Francisco. It's too expensive and I want to go out of state. Well, how do I find one, right? Well, one way, like one of my mentors, Tim Rhodes, says, is ski in somebody else's wake, right? If you've ever gone water skiing, you try to, it's smooth behind the boat. So find a guy like Jason who's already really good at identifying markets and invest with him. The other way is to look at a map like this and say, wow, Florida is looking really good. I'm going to invest in Florida. Then you drill down to Florida and say, okay, well, Tampa, the Panhandle, and Orlando look really good. Okay, I want to do those markets. Then you pull up Tampa and you say, okay, you do the same analysis, right? It's the same process, just narrowing down. You say, okay, well, inside of Tampa, I like this market and this submarket. This one has population decline and low incomes. I'm going to stay out of that one, right? And then you say, okay, so within these submarkets, that's where I'm going to invest. So that's how you determine where you're going to invest. Number one, you can find a great operator like Jason, or if you're going to do it on your own, you get onto a map like this, you understand the overall trends, and then you just start drilling down and apply the same principles that you applied at the large macro level down to the micro level and the submarket level.
Mm-hmm. Here's one thing I do want to say about that. And I agree with everything you said, but every property I've ever bought looks like a great deal in the rearview mirror. Okay. And it's sort of easy to look like a genius in the rearview mirror, because we've had this market, so that just goes back to the old saying, don't wait to buy real estate, and then wait. It would be easy to try and take credit for everything you said. And I appreciate it. I'll take the credit. But, real estate's just such a solid investment with so many things going for it that it's just hard to lose if you buy a property that makes sense the day you buy it. If you do that, you're going to be pretty good.
Can I give an example to illustrate what you just said? Sorry.
Absolutely.
So let's say you buy a house for $100,000 and you put a 15-year mortgage on it and you rent it out, right? And over 15 years, you picked the wrong market. You put 20% down, right? So you put 20 grand into it. You had $80,000 loan. You picked the wrong market. And over 15 years, it does nothing. It's still worth 100 grand at the end. But guess what? A tenant, somebody else paid off that mortgage for you.
Yeah.
And you put in 20 grand. Now you have 100 grand. Is that the best investment in the world? Is that a home run? No,
it's not bad.
It's not bad. You didn't lose and your risk was minimal, right? So a lot of times, even the worst case in real estate isn't all that bad.
Yeah, it's not, especially if you know how to do the math. And a lot of people in real estate, they think they're losing when they're really winning because they just don't know how to keep score. Learn how to do the math. So that's another important thing, because a lot of this return is below the surface of the water, just like an iceberg.
You're absolutely right. You've got, appreciation, hopefully, principal pay down, depreciation, cash flow. There's all kinds of ways to win with real estate.
Mm-hmm. Yeah, definitely. All right, good. What else do you want people to know, Andrew? Anything else on the map? Anything else in general?
I think we covered it pretty well. I would just say, I know it's turbulent times. I know a lot of folks are scared to invest. This is short term. In the scheme of real estate, this is short term, right? Even if this is a 2 or 3 year ordeal, if you're going to buy and hold for 10 years, we are very likely to get into in my opinion, very likely to get into an inflationary environment with all of the worldwide money printing that is going on. One of the best ways to protect yourself against that are hard assets like real estate. Those will appreciate in an inflationary environment. Those are a hedge against inflation. And I can't think of a better way to not only earn a good return, but to protect investment from, like I said, the likely inflationary wave that's coming. And even if we don't get inflation, we haven't really even had it for, well, again, it depends on how you parse it. But
right, it depends on whose stats you're watching.
Yeah, it depends. So many people would say we have not had the high general inflation over the last 10 years. And look how well real estate has done, right? Now we have had asset inflation. So don't be scared about the next 12 months. Or, if you buy something that makes sense today, again, repeating that, and hold it long enough, it's very difficult for that to not work out to be a good investment.
Yeah, definitely. Andrew, do you want to share a social media page or a website or anywhere where people can find out more about you?
Yeah, easiest way to connect with me is my company is Vantage Point Acquisitions. So the website for that is just VPACQ or if you just Google Vantage Point Acquisitions, it'll come up. A couple tabs on there. One, just to contact us and reach out. That comes to my email inbox if you just want to have a conversation. There's a tab on there for our multifamily accelerator mastermind and some additional information. But yeah, that's the best way to get in touch. I'm on LinkedIn and all that, but a real conversation, best way is to reach out to the website.
Good stuff. Andrew, thanks for joining us, and happy investing.
Likewise. Take care, Jason. Good talking with you.